Hey there. If you're looking to make smart investments in 2025, you're in the right place. Today, I'm sharing my top growth stock picks for the year ahead. But first, let's talk about what growth stocks actually are. In simple terms, growth stocks are shares of companies that are expected to grow faster than the average market. These companies often reinvest their profits to expand their business instead of paying dividends. The big benefit? Their stock prices have the potential to skyrocket over time, offering you the chance to make significant gains. While they can be riskier, the rewards can be totally worth it if you choose wisely. Let's dive in. Tech stocks. The tech industry has been a major driver of growth in recent years, and it continues to outperform many other sectors. The rapid pace of technological advancement, along with the increasing reliance on digital solutions across all industries, makes tech stocks an attractive option for investors. From e-commerce platforms to cloud computing and automation, tech companies are at the forefront of innovation. The global shift toward digital transformation, remote work, and the rise of AI and cloud-based services are key factors propelling the growth of these companies. Buying tech stocks means tapping into a sector with immense potential, fueled by ongoing demand for new technologies and solutions. As more businesses move online and leverage technology to enhance productivity, investing in top tech companies today could provide substantial returns in the long run. Now, let's dive into some tech stocks that have the potential to grow quickly and deliver significant profits in 2025. ServiceNow. First, ServiceNow. It's a company that offers a workflow automation platform for enterprise technology management, and they've been growing steadily for 14 years. Right now, their share price is $1,054.15. What's exciting is their impressive 23.5% revenue growth in the last 12 months, with 22.5% subscription growth in Q3 of 2024. This shows that businesses are really responding to ServiceNow's AI-driven solutions, especially as they push for AI-powered digital transformation in various industries. With expected EPS growth of 67% this year and a 5-year outlook of 26.8%, ServiceNow has some serious potential. Analysts are giving it a buy rating, and with an ROE of 16.2%, it's clear that they're not just growing, they're also delivering solid returns. The company is also investing in cutting-edge technologies like agentic AI, which can make decisions and complete tasks on its own, giving ServiceNow an edge in the automation space. If you're looking for a stock that's not just riding the wave of digital transformation, but helping to drive it, ServiceNow could be a smart pick. Shopify. Now, let's dive into Shopify. With a share price of $106.78, Shopify has made a huge name for itself in the e-commerce space, and it's been growing for 11 years. The company now holds about 28% of the e-commerce platform market and pulls in around $8 billion in annual revenue. Shopify's platform allows businesses of all sizes, from solo entrepreneurs to big brands, to sell products online and offline, and it's constantly evolving to stay ahead. Recently, they've added generative AI to help merchants handle customer queries and expanded sales tax management across the EU. The company's growth outlook is strong, with expected EPS growth of 1,156.1% this year and 79% over the next 5 years. Not to mention, Shopify's ROE is 15%, showing it's not just growing, it's profitable too. Analysts are also rating Shopify as a buy, which signals confidence in its future. Shopify is already a major player in e-commerce, and as online shopping continues to grow, it's likely to keep thriving. Both of these stocks offer impressive growth potential, driven by their leadership in their respective spaces. Whether it's ServiceNow's automation and AI-focused solutions or Shopify's dominance in the e-commerce market, these companies are poised to deliver great results in the coming years. If you're looking to invest in the tech sector, these two could definitely be worth considering for your 2025 growth portfolio. Health sector. Let's dive into the health sector, which is one of the most promising industries to invest in, especially as medical advancements continue to accelerate and global demand for healthcare grows. With an aging population, a rise in chronic diseases, and new groundbreaking treatments hitting the market, this sector is primed for substantial growth in the coming years. If you're looking for stocks with strong growth potential, this sector should definitely be on your radar. Eli Lilly. One stock that stands out in the health sector is Eli Lilly. With a share price of $773.29, Eli Lilly has been making waves with its innovative treatments, particularly in diabetes and weight loss. The company's revenue growth has been impressive, with a 27.4% increase in the last 12 months and a 19.2% projected growth over the next 5 years. But what really makes Eli Lilly a top pick for 2025 is its expected EPS growth of 129.7% this year and 41% over the next 5 years. That's a huge leap in profitability, signaling strong potential for investors. Of 65.3% highlights its excellent profitability, and with analysts giving it a strong buy rating, it's clear that Eli Lilly is expected to continue its upward trajectory. In short, Eli Lilly's innovation, growing demand for its drugs, and robust financial performance make it a solid choice for those looking to tap into the health sector's growth potential in 2025. If you're considering investments in this sector, Eli Lilly is definitely worth a closer look. Energy stocks. The energy sector is a great place to look for investments in 2025, especially considering how essential energy is for global economies and the ongoing transition to cleaner sources. Oil, gas, and renewable energy companies have been key players in this space, offering both stability and growth potential. Energy stocks often provide attractive dividends and are seen as defensive investments, which makes them especially appealing in volatile markets. ExxonMobil. Let's talk about ExxonMobil, one of the biggest names in the energy sector. With a share price of $106.93, ExxonMobil stands as a giant in the exploration, development, and distribution of oil, gas, and petroleum products. Its operations are divided into 3 major segments: upstream, which focuses on crude oil and natural gas production; downstream, which handles manufacturing and trading of petroleum products; and chemical, which produces petrochemicals. Founded in 1882 by the legendary John D. Rockefeller, ExxonMobil has grown into a powerhouse headquartered in Irving, Texas. In 2024, the company generated a massive $331.9 billion in revenue, with total assets valued at $377.9 billion and impressive profits of $32.8 billion. Why is ExxonMobil a solid pick? It's a company that thrives on scale and diversification. Whether it's crude oil production, refining petroleum, or creating petrochemicals, ExxonMobil has a robust business model. With consistent profitability and a history of strong performance, it's an attractive choice for investors looking for stability and long-term growth in the energy sector. If you're eyeing energy stocks, ExxonMobil should definitely be on your radar. Secure stocks. When we talk about secure stocks, we're referring to investments that are generally stable, reliable, and provide consistent returns over time. These stocks tend to be less volatile than others, making them a safer choice for investors who are looking for long-term growth with lower risk. Typically, secure stocks belong to well-established companies or are part of a broader market index that represents a diverse mix of companies across various sectors. One of the most secure ways to invest in the stock market is by investing in the S&P 500, which is an index of the 500 largest companies in the U.S. The S&P 500 is considered a benchmark for the U.S. stock market, and it includes companies from different sectors such as technology, healthcare, energy, finance, and consumer goods. Since it covers a wide range of industries, the risk is spread across various sectors, which helps buffer the impact of downturns in any one sector. Why should you buy the S&P 500? The S&P 500 is widely regarded as one of the most secure and reliable investments for the following reasons. Diversity. The S&P 500 is made up of 500 companies from different industries, reducing the risk that comes with putting all your money into one sector. This diversity makes it less susceptible to major fluctuations in any one sector. Proven track record. The S&P 500 has historically delivered solid returns. For example, in the long run, the average annual return of the S&P 500 has been around 7 to 10% after inflation, making it a strong performer compared to other types of investments. Stability. The S&P 500 includes established companies that have been in business for decades, which makes it a more stable investment compared to smaller, newer companies that may be more volatile. Low cost. Investing in an S&P 500 index fund typically comes with low management fees. This means more of your money goes toward the investment rather than being eaten up by fees. Rebalancing. The S&P 500 is regularly rebalanced to ensure it reflects the current economic landscape. Companies that are not performing well may be replaced, which keeps the index competitive and on the cutting edge. Example: S&P 500 index funds. If you're looking to invest in the S&P 500, one of the easiest ways is through an index fund. These funds track the performance of the S&P 500, allowing you to buy into a diversified group of top-performing companies in one single investment. There are several popular S&P 500 index funds to consider, such as Vanguard S&P 500 ETF, VOO. Vanguard's ETF is one of the most popular choices for investors looking to track the S&P 500. With low expense ratios, it's a cost-effective way to invest in the index. SPDR S&P 500 ETF, SPY. This is one of the largest and most liquid S&P 500 ETFs, offering exposure to the top 500 companies in the U.S. It's another great option for those seeking broad market exposure. Why should you buy these? Long-term growth. The S&P 500 has shown strong long-term growth, making it an excellent option for investors who want to see their money grow over time. While individual stocks may fluctuate, the S&P 500's diversified nature helps stabilize returns, especially over several years or decades. Safe bet for beginners. If you're new to investing, the S&P 500 is often recommended because it provides exposure to top U.S. companies without requiring you to pick individual stocks. This makes it a secure and beginner-friendly option for those looking to build wealth. Inflation hedge. Historically, the S&P 500 has outpaced inflation, which means your investment grows faster than the cost of living over time. This is a crucial feature for long-term investors. Accessible. With low-cost options like ETFs, you can start investing in the S&P 500 with relatively small amounts of money, making it accessible for a wide range of investors. That's a wrap on my top growth stock picks for 2025. I hope you're as excited as I am about the potential of these stocks. Remember, the key to successful investing is to do your research and stay informed. If you found this video helpful, make sure to hit that subscribe button and turn on the notifications so you won't miss any of my future updates. Also, feel free to drop any questions or thoughts in the comments. I love hearing from you folks. Thanks for tuning in, and here's to making 2025 a great year for your investments.